Hey, welcome back everyone. It is time for another red hot covered call video. Hey, look, so many things have been happening in the stock market, man. I could talk for days. I have so many trades that have been winners and losers for which I'm going to give you an update. I'm going to give you a car session video update on all those trades in a midweek update later this week. So I want you to come back to the channel. So look, before we get going, let me get this out of the way. If you like what you hear today, I want you to subscribe to the channel. It's right there and it's free. And hey, look, if you like this video today, I want you to bang that like button because it lets me know you like what I'm doing. And what we're doing is this. Today we're going to talk about market makers and how they play a role in your covered call and cash secure put options. Very specifically, covered call options. Because a lot of times this misunderstood entity that sits between you the seller of options, and they, the buyers of options, normally we don't talk about this. So today I want to talk about how they could affect your trade, even if the person that bought your option is not making money. We're going to talk about that today. We're also going to talk about deja vu all over again with my range trade Chevron. If you remember, about 3 months ago, I bought Chevron when it was trading lower in my Keltner channel range. I felt good with the entry, went ahead, wrote some covered calls, collected a dividend. Well, hey, it has happened again, and I'm going to talk to you about that trade because I did use the Keltner channel indicator again, and I'm going to collect a dividend. I'm going to talk about how that trade might play out. It's one of those double dipping trades that I always talk about. Love collecting that nice covered call premium and collecting a dividend. I'm going to show you how I did it today, and I think you're going to like it. Now, before we get to those topics today, I want to show you cats something that I've been doing with the CTP dashboard. Hey, look, I'm always in the lab trying to up my game. See, I use the CTP dashboard every week myself because I wanted an easy way to find great new covered call candidates. Hey, look, I always talk about having that basket of great stocks that I use to write covered calls. But look, I'm always looking for my next great covered call. And that's what I did. I created the CTP dashboard. I load it every Wednesday, and I keep updating the dashboard. I love adding new features because it ups my game, and I offer it to you for free, upping your game. Now, I see a lot of you cats in there every single week checking out the new updates. But look, so many people have emailed me saying, look, add a column showing the new stocks that have made the list from the prior week. So that's what I did. I went ahead and added a new column in the CTP dashboard where when I upload it every Wednesday for free, you can immediately see what new stocks have hit the list. And if you download the copy, like I say, in the how to use video, you could actually sort by new and you'll see them all right at the top. And that is the beautiful feature of the CTP dashboard. It's dynamic. It's not some static PDF. And I load it every Wednesday, and look, it helps you with your research, right? You're able to then highlight a stock that you want to watch, and when you go through the list and you start picking all the different stocks that you want to watch, you're able to then sort that column from top to bottom. You're able to then keep the numbers in front of you. So look, I want you to go to ctpdashboard.com. I want you to download the free version of the CTP dashboard and use it to start your research. Hey, look, let's go ahead and talk about the market makers and how they affect your trading. Now, one of the things I really enjoyed as I was learning this covered call game and how the market makers play an important role in our covered call options is watching this video right here. I watched this video a couple years ago, and one, it's phenomenal. I love it because it talks about the 1987 crash, and growing up, this was a very big deal, even though I wasn't in the stock market back then. Tasty Trade, who puts this video on, they were actually market makers during this crash, and they talk about the inner workings of market makers when the stocks are moving higher or lower. And in this case, they talk about how they were feeling when the market crashed. It is a great educational video. It's a great documentary to watch, and it really paints a good picture of what a market maker does and how they buy stock, right? They have to actually put real money in the game. So what you do is search 1987 stock market crash, and it's right there. That is a great video to watch. And hell, I might even watch it after this video. Now look, I'm going to give it to you straight talk style. I never profess to be an expert. All I profess to be is a cat just like you that has tons of experience. So please, give me a little bit of runway to land this sucker. What I'm really trying to do here is to have you understand from the seller's perspective of how market makers will affect your trades. And more importantly, when your stock goes above the strike price, but the buyer is losing money, there is a perception that your shares might not be taken away. And I definitely want to set you straight on that. So let's go ahead and take a look at this setup with AQ. Again, again, I'm trying to keep the numbers straight here. This is a hypothetical trade, and I really think this is going to clear up any questions you might have about how market makers might affect your trade. So let's go ahead and look at this trade. So AQ is trading at about 11.93. Right now, if we wrote this covered call, a 13.50 strike, and we get paid $1.50 for it. This is how this trade works out. Obviously, this person is buying the right, but not the obligation to take your shares away from you at 13.50. Now they're paying $1.50 for that right. For whatever reason, they're going to pay you $1.50. I'm not sure, but hey, we're the sellers, so if that trade makes sense for us, we're going to take it. Well, in this case, think of the buyer side. The buyer starts to make money after $15. So really, when the buyer does this trade, when they purchase your call option, they don't make money until it gets above $15. So clearly they're playing a hunch that instead of buying AQ for $11.93 right now, hoping it goes to $13.50, they're going to spend a little bit of money buying your call option. And if it gets to $13.50, they're okay with it. Their hunch was correct. They'll take your shares at $13.50 and they'll move on. But the reality is their cost here is $13.50 plus the $1.50. So their cost is $15. So as a seller, it becomes very obvious that anything above $13.50 and below $15, one would think that the buyer of your option is not going to make money, so they won't take your shares. That would absolutely be the wrong way to look at this, because there's two scenarios playing out here. One, the market maker, anything above $13.50, whether it's 1 penny above $13.50, market maker will come in that Saturday after the Friday expiration, take your shares from you at $13.50, and they will sell it for $13.51, picking up a penny profit for every share. See, they have no cost, so they're able to just come right in, take your shares from you, give you your $13.50, but because they have no cost, they could just push a button and all those trades will clear. So it's very important to understand, anything above $13.50, the market maker will take your shares. From the buyer's perspective, think of it this way. They may take your shares. They may want to take your shares. Why? Because remember, they paid $1.50 for the right to take your shares at $13.50. Well, for them, say the stock's trading at 14. Well, for them, they're still losing $1 on the premium they paid. Here's the deal. They might take your shares because they lose less. Think of it for a second. You have the right to buy somebody's shares at $13.50. The stock's trading at 14. You paid $1.50 for that right. If you take somebody's shares away from them at $13.50 and sell them immediately at 14, you lose $1 on the overall trade versus the $1.50. There are many reasons why you will have your shares taken away at $13.50. It's very important to understand. You can't look at it from the seller's perspective. Man, that person lost a lot of money. They'll never take my share. Look, I've had that happen to me a couple times with Win, where I got a $6 premium and the stock traded between the strike price and the break-even price, and there was no way they were going to take my shares, right? Well, the market maker ended up taking my shares because for them, there's no cost. Now, with that said, do I truly know that the market maker took my shares, or maybe the buyer took my shares? I don't know. The important thing to understand here is if I didn't want my shares taken away, I needed to buy the option back. And that's what I talk about all the time. Real quick, let's talk about this scenario. AQ is now trading at $13.51. We're on the day of expiration, and we may not want our shares taken away, right? So here's what we're going to have to do. So we got paid $1.50, right? Now, the stock's trading 1 penny over the strike price on expiration Friday. So as you know, an option has real money and time value as a part of its price. Well, the $1.50 I got paid obviously has shrunk down because there's no time value portion of that option price anymore. Chances are it's real money and maybe a sliver of time value. So this option for which I got paid $1.50, probably trading for 2 pennies. Right? It's 1 penny over the strike price. So what I'm going to do in this situation, because Fidelity does not charge me a fee for options that are 10 cents or under, I'm going to come in, I'm going to buy that option back for 2 pennies, alleviating the obligation. I profit $1.48 on this option. I can do one of two things now. I can either sell my shares immediately, we move on, I have the cash in my account on that Friday, and I might buy another stock and do this again, or I'll go ahead and write the next profitable covered call on AQ. Look, this is about the bigger picture of exit strategies and when you buy back options. But I hope I was able to paint this picture of how the market makers will affect your covered call trades. Because anything above that strike price, hey, whether it's the buyer or the market maker, your shares are going to be taken away. And a lot of times you might not want your shares taken away and you feel like you have no option. Well, you do. You could buy it back. You could then move on to your next trade. Okay, let's finish up with that Chevron trade where I'm double dipping the profits. Hey, look, if you've been watching my channel, you absolutely know I love to play this as a game. I know this isn't a game and I try to treat it like a business, but man, it just excites me to make trades where I try to double dip profits, where I'll buy a stock low, hope to sell that out of the money covered call, collecting a little bit of stock appreciation, collect the juicy premium, and collect the dividend. I feel like I'm double dipping the profits. And if you remember the last time I did this with Chevron. And Chevron's one stock that I absolutely love doing this with because it trades in this manageable range. You know, it doesn't rocket higher or fall off the table. Chevron's one of those great companies. Wall Street loves them. They pay the huge dividend. What I love to do is buy Chevron, write that 1 month covered call, and collect the dividend. So let me show you how I did that this time. But last time I did this, it wasn't that long ago that I did this on Chevron earlier this year. And I'm telling you, if you find that great S&P type company for which you feel comfortable to own, you could actually buy the stock, write the covered call, and collect the dividend as well. Now let me show you how that trade sets up. So again, I know the Keltner channels are not the end-all be-all of good entry point indicators, right? But after watching that Chuck Hughes videos that I told you about a couple weeks ago, I find that every time one of my favorite stocks hits the lower band of the Keltner channel, it usually is a good entry point. Now, had I did that with Alibaba a couple weeks ago, I'd have been completely wrong. But in the case of Chevron, I've noticed that it actually works for me. And recently, Chevron had fallen off to levels where I wanted to get back into it. So let me revisit what the last trade was all about. Last time I bought Chevron was actually rallying and then it dipped off to about 121x. And I figured, look, that was a great entry point for me. I went ahead and picked up some shares. And I noticed 30 days, a 30-day covered call would put me smack dab at the ex-dividend date. Now, Chevron pays $1.12 per quarter. And I was going to get $1.10 for the premium, the covered call premium. So this was a chance to double dip. What I did, instead of writing that 30-day covered call, I wrote a 45-day covered call, hoping that I would hold the stock through the ex-dividend date and then maybe the following week have my shares taken away at a higher price. Well, that didn't actually happen, but that was the idea. And as Chevron bounced back and forth, I was able to write covered calls, buy them back. And when the stock got low near the bottom of the Keltner channel, I bought some shares. So ultimately, I was reducing my cost basis from that 121 all the way down to 117x. So when I wrote my last covered call, I write that 125, have my shares taken away, and hey, look, I'm looking for the next time Chevron falls to the bottom of the Keltner channel. Well, guess what? That's exactly what happened. As Chevron starts to fall, I missed that buy. And as it rallies ahead, I said, look, if this thing falls back, I'm going to go ahead and pick up some shares. So what I did, sure enough, when Chevron got down to 117x, I went ahead and picked up some shares. I wrote that 45-day cover call because guess what's happening right here? In 30 days, the ex-dividend date. So I wrote a 45-day covered call, $1.10 covered call premium, $1.12 on the dividend. So this trade, cash on cash, is going to be 6% if my shares are taken away. And as you can see, every single time it hits the lower band of that Keltner channel, it just wants to keep going higher. It wants to bounce higher. So for me, I'm looking at it like this is one of those great opportunities to buy one of my favorite stocks, buy it at the low end of the Keltner channel, write that out of the money covered call. And in this case, try to pick up a dividend as well. Now look, I may have my shares taken away. I have an out of the money 123 strike and it's 1 week after the ex-dividend date. If Chevron trades above 123 near the ex-dividend date, there is a chance my shares will be taken away that night, giving me 123 a share. I missed the dividend, but hey, I make a nice profit either way. In this case, just like the last time I did this, I have a hunch that I'm going to hold the stock through the ex-dividend and I'm going to make this 6% cash on cash. And this is what I call my cash printing machine. See, look, if we get our financial education, we get our experience, we can do this and have success. Hey, look, I hope you liked this video today. And if anything, you learned something. That's what it's all about. That's why I'm here. I love showing you my trades. We talk about them and you learn something. So many times people lose money in the stock market. Hell, even I lose money in the stock market. It's about having that financial education, getting that experience so we can have success. Look, you too can have the same success that I'm having if you just put in your homework, if you just put in your time. And hey, look, as always, I'm always pulling for you. Now look, before I go, remember, go back to the CTPdashboard.com, download the free version of the dashboard, and use it to find your next great cover call candidate. And hey, let me know in the comments below what stocks you're using for dividend capture and cover call writing, because man, I love double dipping the covered call and the dividend in the same purchase cycle. That's what it's all about. Getting excited so we can have success. Hey, look, if you like this video today, I want you to bang that like button and look, let others know we're talking the good word of the covered call. Until next time, I hope all your covered calls are profitable.
All I see is signs, all I see is dollar signs. Oh, money on my mind.